Welcome to Growth Investing Mastery. This video will look at our top 3 earnings reports from August 2025. As a reminder, this is not investment advice or recommendations to buy any stocks. The purpose of this video is to learn about promising growth names that reported stellar results this week. We want to be in stocks with the best prospects currently, and we want to find compelling earnings reports with strong numbers and narrative. Understanding and analyzing earnings reports will drive our investing returns. And this channel is up 284% since the start of 2024. If you're familiar with my content, it's probably no surprise to see Astera Labs come in at number 1 with the symbol ALAB. They had a really impressive earnings report this week, and they're a next-gen AI hardware maker. They introduced a new term this earnings call called AI Infrastructure 2.0. Let's jump into the Q2 guides versus the actual numbers they landed at. Revenue was guided from 170 million to 175, and they landed at 192 million, which was up 20% quarter over quarter and 150% year over year. These growth rates were also an acceleration from the previous quarter's growth rates. And GAAP EPS was projected from 10 cents to 11 cents, which landed all the way at 29 cents, a very large beat there. Adjusted EPS was guided from 32 cents to 33 cents, and that came in at 44 cents. Additionally, the new Q3 guide had revenue guided from 203 million to 210 million, a nice step up. GAAP EPS was guided from 23 cents to 24 cents, and you might notice that's a bit lower than the current 29 cents are reported, but in the past, Astera has usually guided this GAAP EPS to be about the run rate or slightly lower, so I'm not too concerned with that. And adjusted EPS was guided from 38 cents to 39 cents. I like to make guesses before the earnings report of where revenue and the new guidance will end. And I had guessed Q3 guidance would be from 205 to 210 million, and it landed exactly like that. So it's great to see when we really have the pulse on where the company is headed. And they did give a lot of hints that Q3 was going to be strong, so I thought they could raise their guidance quite significantly. Let's now dive into the numbers for Astera Labs on their Q2 report. First, I want to look at the impressive net income trend they've had over the last year. It's gone from negative 7.5 million to negative 7.6 to positive 24.7 to 31.8 and then to 51.2 million in the latest quarter. And what I like here is there's a nice jump up of about 20 million of new net income, whereas on the previous quarter, it was only jumping up about 7 million sequentially. Additionally, gross margin has started accelerating again. 5 quarters ago, it was 78%, and then it was 78%. It went down to 74%, then to 75%, and in this latest quarter, gross margin was 76%. So we can see it creeping back up again, which is nice. GAAP operating income was 39.8 million, and their operating margin in the quarter was 20.7%. Their Scorpio product line exceeded 10% of revenue in the quarter, and this surprised some analysts. This is significant because the company originally projected that Scorpio would make up 10% of revenue in 2025, but already in Q2, Scorpio is over 10%, and the analysts noted that probably means Scorpio is going to be well above 10% for the year. Cash flow from operating activities was 135.4 million. The company's cash balance is now 1.07 billion, and that's up from 925 million in the previous quarter. R&D expenses in the quarter were 48.9 million, with sales and marketing at 9.4 million and G&A at 12.4 million. What really stands out to me there is that sales and marketing is quite low, and the product seems to sell itself. They don't need to do a whole lot of advertising, and industry insiders know to come to Astera. They also mentioned there's a new tax law of 13% going into 2026, and that surprised me. That seems quite low, but it's definitely good for the company. Let's now take a look at the narrative for Astera Labs. They started ramping PCIe 6 product portfolio in volume production in Q2. There's multiple new design wins for Scorpio fabric switches, and the company is expanding collaboration with NVIDIA through the NVLink Fusion partnership. Astera also hosted the UA Link public webinar as a promoter member. And the business lines are getting more diversified. They have 3 product lines that are over 10% of revenue now. Those include their Aries, Taurus, and Scorpio product lines. They also mentioned the Scorpio X series engagement is with over 10 unique AI platform providers. And one analyst was asking, is that just one product at 10 different companies, or is it multiple products? And Astera was clear. It's a lot of different products at 10 separate companies. The company also mentioned Scorpio is shifting to high volume production in 2026, and proliferation of UA Link in 2027 will be a long-term growth vector. And this is part of the reason I find the narrative so strong for Astera Labs. In the Q1 report, they were talking about a strong Q2 and a strong second half of 2025. Now they're talking about the high volume production really ramps in 2026, and it's going to be even bigger in 2027. One direct quote regarding Scorpio was, "It's a greenfield application for us, with a much broader deployment." Additionally, the Leo CXL controller shipped in pre-production volumes, and that's their 4th main product. The Cosmos software platform customizes products for the customer, and it ends up serving as an anchor socket designed upfront. Here's one more quote I liked from the report. "We have the engagements, we have the design wins. Now it's a matter of all these platforms getting qualified and ramping to production." Coming in at number 2 is AppLovin, with symbol app, and they are an ad tech platform that is set to disrupt the industry. They reported earnings on August 6th, and taking a look at Q2 guides versus actuals, advertising revenue was projected from $1,195 million to $1,215 million, and it landed at $1,259 million, which was up 9% quarter over quarter and 77% year over year. While adjusted EBITDA was projected from $970 million to $990 million, and that landed at $1,018. The new Q3 guide is for revenue between $1,320 million and $1,340 million. That's with adjusted EBITDA of $1,070 million to $1,090 million. And I'd rather see forward-looking guidance come in ahead of my guess, so that's a good sign. And this is really crazy, but I did confirm with an investment banker that there was a memo sent out about a sequential revenue decline within the industry. If you're familiar with AppLovin's business, they sold off their gaming business last quarter, and so that pretty much guaranteed a sequential revenue decline. And the company was pretty clear they're going to be reporting advertising revenue, but still the algorithms messed it up. And it traded down heavily after hours, but today on August 7th, it rocketed back up. Let's now take a look at the Q2 numbers for AppLovin. Adjusted EBITDA nearly doubled to $1.2 billion, and they had an 81% adjusted EBITDA margin. Free cash flow was $768 million, which was up 72% year over year. And the company's still been doing share buybacks. Shares outstanding was 346 million in Q4 of 2024, and now it's down 4 million to 342 million shares outstanding. And the gaming category is still growing 30 to 40%, well above their long-term goals. And AppLovin is growing faster itself than the gaming industry. And you can see this slide is really short, and even the company is really emphasizing the story rather than the metrics now. And the metrics are incredible, but they're just reporting mostly revenue and adjusted EBITDA and not getting into the weeds too much on other metrics. One thing that was kind of interesting was that management had said adjusted EBITDA per employee was the best way to track progress with the company. But I didn't catch them reporting that number actually in this report, but I think it's okay. It's still going up because adjusted EBITDA is going up and employee count isn't growing that fast. Let's now take a look at the AppLovin narrative. And you'll notice this slide is much longer than the numbers slide for AppLovin. When I first bought into AppLovin in 2024, it was really a numbers stock for me. What I mean by that is the numbers were really compelling, but I wasn't really sold on the AppLovin product. It seemed kind of gimmicky to me in the mobile game space. But I learned about the product over time, and right now I actually find the narrative more compelling than the numbers for AppLovin. And this is keeping in mind the numbers are still really, really strong for AppLovin. The company is launching their self-service portal, which is a framework for automatically generated ads. And they've given us a concrete timeline of how this is going to play out. On October 1st, the start of Q4, the Axon Ads Manager will begin on a referral basis, and the global launch of this product will happen in the first half of 2026. They did mention they'll do paid advertising of Axon to recruit new advertisers. And this is kind of interesting because historically management has really been against doing much sales and marketing. Another key takeaway was they said they can use their own platform to advertise, and that means they can run their own ads for free. And they also pointed out they don't need any sales force to do this. A couple of great quotes from the call were, "What happens when we can really open it up and service all the small businesses in the world?" Later, they added, "We've got one of the most lucrative financial models the world has ever seen." The company mentioned in Q4 of 2024, they did a huge ramp up on the web pilot customers, but recently they've intentionally held back growth. And they said this is because they want to really have it be self-service and they don't want to have all these sales reps needing to work with the clients, which wouldn't really be scalable as they go global. And they've just completed working through all the integrations. They announced a Shopify app integration. They said Q4 of 2025 will have a huge ramp up during the holiday season. Another thing they mentioned was that marketing influencers are already promoting the new product. They said opening up the platform, it already gets more demand, but it also gets more data as well. And this creates a flywheel effect. Comparing to Meta, the transactions that app drives happen faster, and they typically close the transaction within 1 or 2 hours, whereas Meta has a longer time frame. So right here, AppLovin is saying they have a superior product to Meta. I found one direct quote about seasonality in the quarter. They said Q2 isn't particularly strong seasonally in the category, but we still grew at a really healthy rate. And that does kind of explain why they landed maybe a little below my expectations, but they were able to guide quite a bit higher than I thought for Q3. And I really love this quote from management. They said, "The reality is like Q4 is going to end up being a fun quarter." And the word like was in there. And sometimes I mention when management's stumbling over words, whether it's positive or negative, it kind of gives a leading indicator. And I think management is really hyped up about this Q4, which is just going to be huge for the company. And looking at the extreme bullish case for this company, I think there is an outcome where they end up disrupting Meta's business significantly. I also added a question here. Is there a ROAS or return on ad spend tipping point to unlock the infinite money glitch? And I put infinite money glitch in quotes. That's maybe a gaming thing where, you unlock some cheat code in a game and all of a sudden you have, 999 money in the game. And the reason I mentioned that was AppLovin's been talking about where customers spend $1 and they get $2 back in sales. And the tipping point really occurs when they start getting $1 or greater in earnings. So if the company is able to spend $1 and get $1.01 back in earnings, then they're going to try and spend that as much as possible. And they'll keep spending that because it's a self-fulfilling cycle, sort of. But if that number is below $1, so if they spend $1 and get 99 cents back, then they're not going to want to perpetually do that. And right now with Google and Facebook ads, they don't have that ROAS tipping point, but I'm really wondering if AppLovin can get above that tipping point. Let's now take a look at our third company, which had an impressive earnings report, and that was Dave Inc., with symbol Dave. Their product is membership-based banking, and they reported earnings on August 6th. Taking a look at the Q2 guides versus actuals, for full year 2025, the company projected revenue from $460 million to $475 million, and they raised that after this earnings to $505 million to $515 million, which would be up 48% at the top end of the guide. Adjusted EBITDA for 2025 was originally projected from 155 to 165 million, and they revised that upwards to 180 to 190 million, which would be up 120% year over year. One thing I like here is that adjusted EBITDA is growing even faster than revenue, so the company is getting more profitable over time. Taking a look at analyst estimates for Q2, revenue was projected by analysts to come in at 114 million, and it landed well ahead of that at 132 million. Adjusted EBITDA was projected by analysts to be 37 million, and that also landed higher at 51 million. My guess for this company on revenue was that they would get 121 million, but it came in 11 million higher, which was much higher than I was expecting. I originally saw the stock was down about 5% after hours to $240 a share, and I thought it was a good idea to start adding at that price. However, it ended up absolutely crashing after that, going all the way down to 200 and then even to $180 a share. And I was adding at different price points as it was going down because the numbers looked so strong to me. And I was still waiting for the conference call because I wanted to confirm there wasn't something strange in the conference call. But listening to the call, my confidence was increased even further, and I added even more shares after that. Taking a look at the numbers for Dave, revenue was up 64% year over year at 132 million, and that's a record for the year over year revenue growth rate. Extra cash originations grew 51% year over year and 17% quarter over quarter. And that's great to see such a large quarter over quarter step up here. Adjusted gross profit was 92 million, which was up 78% year over year. And adjusted EBITDA was 51 million, up an impressive 236% year over year. That's with adjusted net income up 233% year over year. There was also a record GAAP gross margin of 69%. Customer acquisition costs, or CAC, was $19 in the quarter, and the payback period has gone down to 4 months for acquiring a customer. That's down from 5 months previously. The company has 2.6 million monthly transacting members, which is up 16% year over year. That does seem pretty low to me, and I would like to see that number higher. It might be something to investigate, but I'm not overly concerned right now. Average revenue per user increased 42% year over year, and management called this a step change up. Processing and servicing costs were down 4% year over year, and financial network and transaction costs were up 11% year over year. It's great to see these cost metrics either going down or staying relatively flat at the scale that Dave is operating at. Average revenue per employee was up 66% year over year, so it's now 1.9 million revenue per average employee versus 1.1 million a year ago. Most companies don't report this average revenue per employee or average EBITDA per employee, but companies which have really impressive metrics like AppLovin or Dave, they like to advertise these metrics. Whereas companies which are overstaffed on employees, they never mention these metrics because they don't sound very good. The company also added flow through from gross profit to EBITDA was approximately 90%, and that's really impressive. The cash balance for this company was 105 million in the quarter. That's up from 90 million in Q1, and they said they'll do opportunistic share repurchases. Let's examine the narrative for Dave. They expect to scale up marketing investment through the back half of the year, and they had dormant member reactivation with strong retention in the quarter. There's a new model they have called version 5.5, which includes the new fee structure, and it has big improvements to performance. A significant portion of extra cash originations are going to the Dave card by the customer's choice. And Dave is raising its monthly subscription fee from $1 to $3. The company mentioned multiple times they tested extensively, and customers are completely okay with the new fee as Dave is offering more features over time. There's a new partnership with Coastal Community Bank, and this moves the way that Dave handles receivables. It will free up $100 million in capital for them. I didn't look too deeply yet into this partnership, but this is definitely a thread worth diving into a bit more on how this deal was structured with Coastal Community. The company said they're building up cash as dry powder, and it's encouraging to see this company is very profitable already and adding to their balance sheet every quarter now. Analysts were giving their congratulations on the call. One analyst said, "Great results here once again in Q2." And another added, "Congrats on the results." That's in very big contrast to the stock price, which crashed 22%. And you can see here the analysts recognize this is a really impressive report. Management also discussed they're still very bullish on new customer ads, and their goal is driving gross profits, not getting the lowest level loss rates. There is one potential concern I have, and Dave discussed this. It affects a lot of different payment processors and buy now, pay later products. And this is JP Morgan's pricing power on fees. They apparently have the power to raise fees, which they've been openly discussing. However, there is significant pushback from the Consumer Financial Protection Bureau, and they've been pushing back quite strongly, and it sounds like that won't go through now, but it is something to look out for. And Dave said on their side, they won't have to shoulder 100% of the fee increase because they have power to price things themselves. And in a worst case scenario, Dave could pass on some of that fee increase to customers, but hopefully they don't need to do that. Now it's the slide you've been waiting for. How does my portfolio look after all the shakeups and the crazy earnings reports this week? Two of the companies we mentioned, AppLovin and Astera Labs, are my highest confidence positions. AppLovin is 21.5%, and Astera is now 19.7%. I have two medium to high confidence positions. One is Reddit at 13.4%, and the other is Dave Inc. at 11.4%. And you can see Dave has moved up the list quite a bit. Then there's three newer companies in the medium confidence range, which are Iron at 6.4%, and then Powerfleet, AIoT at 6.3%, Credo, CRDO at 6.3%. And then we have three low confidence positions. The first is Health and Tech, HIT, at 4.7%, Hims and Hers Health, Hims at 2.7%, and Cineverse, CNVS, at 2.8%. I did end today, August 7th, with 4.9% of cash, and I sold Sezzle after hours after I found their revenue number to be very disappointing along with their guidance. I did redeploy some of that cash from Sezzle to other companies, but in the after-hours market, the bid-ask spread can be quite wide, especially on those smaller companies, so I decided to wait till tomorrow. But some of the companies have a pretty close bid-ask spread in the after-hours, and I was okay to take some extra positions there. I did get some unfortunate pricing selling Sezzle around $101 a share and $105 a share. I thought it was worthwhile to mention our approach works making our decisions off company results and not optimizing over exact prices we need to get in order to sell. I also mentioned I was buying Dave at $240 a share in the after hours market, and that doesn't look too bright when the share price goes down to 180 after that. But I really thought the Dave report was a phenomenal result, so I was comfortable adding as it was going down. One more thing to note is I'm going to sell that Hims and Hers Health position next week at 2.7%. And some of my lots lap long-term capital gains next week, so it made sense to wait that extra week to pay the lower tax rate. But I do consider that Hims position is basically a cash equivalent, or it's just another 2.7% that I'm going to add to other stocks next week. Overall, even though we had three really impressive reports with Astera Labs, AppLovin, and Dave, there were a number of disappointments in earnings season, and we sold five companies during earnings season, which is quite a lot of companies to be wrong on. We sold Paymentus, Paysign, Nova, Sezzle, and Hims. One key lesson here is that our approach does well by reallocating to other high confidence positions when a company disappoints on numbers or narrative. And we are not selecting correctly all the time, and it's common to be disappointed by some of our earnings reports. Ideally, I like to make it through earnings season selling as few companies as possible, but sometimes it plays out like this where we sell a lot of companies during earnings. The nice thing though is I freed up some space to potentially add new stocks, as I had 13 stocks before, and I typically recommend 7 to 11 stocks. Yet, despite all the selling of five companies, our portfolio is up 56% year to date, which is an increase from 53% in our July portfolio review. This leaves our results at being up 284% since the start of 2024, a result we're of course pleased with. This concludes the video for our top three companies of this earnings season, and let me know what you thought in the comments below. This was a new format I was experimenting with where I cover three earnings reports in depth in one video like this. So let me know if you think it's better doing just one video at a time per company or if this format's working. Thank you. And just as a final reminder, this is not investment advice or recommendations to buy stocks.